I am so pleased to have the honor to introduce our our keynote speaker today. Eswar Prasad is the Talani Senior Professor of Trade Policy and Professor of Economics at Cornell University. In addition, he is a Senior Fellow at the Brookings Institution. Of course, he is also a Research Associate at the National Bureau of Economic Research. And on top of that, he is the former head of the IMF's China division. He knows a lot about currencies. He has written books about currencies. In the past, he wrote The Rise of the Renminbi. He wrote a book about the dollar trap, how the US dollar tightened its grip on global finance. And I believe his most recent book, was The Future of Money, How the Digital Revolution is Transforming Currencies and Finance, which came out a couple of years ago, made the best lists of best economics books of 2021 by The Economist, the Financial Times, and Foreign Affairs. So I imagine that that book is the reason that he's invited to be our speaker today. He's done lots of other impressive things as well, but I always like to give a little personal information about a keynote speaker. Did you know, now there might be a couple of people in the room besides Eswar himself and I who know this, which is that his name, Eswar, actually means Lord Shiva, God, Supreme Being, Special Self. Pretty impressive, right? I don't know, when you're named that as a baby, that's a lot to live up to. So I understand the inside story is that his parents gave him a nickname to lower expectations just a little bit. His nickname was Raja, which of course means emperor. With that, I give you Eswar Prasad and his talk. It's all yours.
Thank you, Pam. Well, it can only go downhill from here, given how we are starting. But this is a wonderful time and an interesting location to be talking about cryptocurrencies and the future of this entire ecosystem. We are surrounded by a lot of old architecture, and here we are in a fancy new building built with fancy new technology. It's also interesting to think a little bit about what juncture we are at in the development of the crypto ecosystem. Of course, we've had a few very hard months followed by some slightly better months. But what is interesting is that over this entire period, the amount of interest in the development community among the financing community has stayed very strong. You know, since I wrote a book on the future of money, I get invited, as I used to in the past, to monetary economics conferences, central banking conferences, but in the last couple of years also to a lot of crypto conferences. I can count by my measure right now, I've sat on panels with 3 people so far who've claimed to be the real Satoshi Nakamoto. Not all of them are entirely credible. But what is interesting is that even during the darkest periods that the crypto community experienced in the last few months, at least in terms of crypto values, the amount of enthusiasm and excitement among developers, among financiers really seemed to be very high. In January, I was at this fancy conference in St. Moritz, which had many of the luminaries in this space, like Binance's Chanping Zhao and other luminaries such as Anthony Scaramucci, and there seemed to be very little concern about the fact that cryptocurrencies had taken a real hit in terms of their valuations, because there seemed to be enormous excitement that this technology had a lot of room to develop. So when I think a little bit about cryptos, I want to go over a few aspects today. First, to think about whether the promise that cryptos seem to have, that we might move to a world with more decentralized architectures, which would prove to be more robust and resilient, and thereby democratize finance, whether that's really held up. I then want to talk about a specific piece of research which touches upon some of these issues and also upon some issues that we talked about this morning. And then again, broaden the picture to talk about the regulatory landscape, what it might evolve like, what it might mean for the crypto ecosystem, and then talk about what all of this mean for where we started, which is the nature of money in terms of its different forms and functions, and then talk about an issue that is dear to my heart, which is the international monetary system, and whether in fact we might see substantial changes as a result of the crypto revolution. as we think about where the crypto revolution has taken us so far, the promise of decentralization was, I think, a very exciting one. The notion that you didn't need trusted intermediaries, the notion that you could substantially increase access to financial markets, financial instruments, products and services, both on the supply side and the demand side. In other words, anybody, no matter what their income and net worth, would very easily have access to a broad suite of financial products and services for managing credit, risk, savings, and so on. And on the other side, that you could have developers, financial institutions have relatively easy entry into these markets was a very compelling proposition. Now, it's not quite worked out that way. If you look at what has happened in terms of the world of cryptocurrencies, what we see is a lot more centralization. If you think about what Bitcoin was supposed to deliver to us, it was a medium of exchange. Now, as we know, Bitcoin did not serve very well in that function. At some level, it's become a purely speculative financial asset. This always creates a lot of groans and boos in a cryptocurrency conference. But I see that there are more sober minds here. It turns out that as a medium of exchange, it does not work very well. We know about the efficiency, cost, and time to settlement problems. And of course, we have layer 2 solutions like the Lightning Network that make it work a lot better. But fundamentally, the volatile value means that it doesn't serve very well as a medium of exchange. Now, what is interesting is that, of course, we have a suite of cryptocurrencies that have come up that try to deal with individual flaws of Bitcoin. You have Monero and Zcash and a variety of other crypto coins which give you much stronger anonymity. And then, of course, you have stable coins which give you much more stable value relative to the unit of account, which is the fiat currency. Now, stable coins work well, but they are an example of enormous irony in the sense that the whole point of Bitcoin was to get us away from the dependence on fiat currencies. And yet, the reason stable coins work is because they are backed up by stores of fiat currencies. And the ones that seem to work very well as payment systems are really the fiat currency-backed stable coins rather than the algorithmic stable coins. Now, if you think about stable coins, they do seem to be getting traction because there is need for better payment systems domestically, especially in the US, in terms of international payments. And of course, when we think about blockchain-based ecosystems, we need a unit of account and a medium of exchange that works well. Now, the unit of account function still remains very much with fiat currencies, but stable coins I think of as more effective ways digitally of using the fiat currency. But if you think about what underlies stable coins, you could potentially have a decentralized architecture. But once you start thinking about the governance, the validation mechanisms, the consensus protocols, all of these are very centralized. So the notion that you can get away from centralization and still deliver a medium of exchange has not quite been fulfilled. And then as you start looking at the broader ecosystem, the whole point of cryptocurrencies, again, was to get away from centralization for custodying or trading of assets. And yet, if you look at a large amount of where the cryptocurrencies are held, especially by retail investors, it is at centralized exchanges. If you think about the trading activity, much of it occurs simply because it's much easier at the front end to do it through a centralized exchange, like Coinbase, or if you were from a few times ago, from FTX, and so on. So what we are seeing actually is a very unfortunate outcome in my view. What we are seeing is a degree of centralization that creates a lot of the traditional vulnerabilities that we had in traditional finance without getting us away, but doing so with many new technologies. Even if you think about something like Bitcoin, which is really decentralized at heart, we see that there is a small number of mining pools, maybe 6 to 8 of them, that control much of the hashing power on that network. So my concern here with this technology, which I still view as promising, is that if we think about the democratization of finance, about the easier access to new players, we are really not getting there. And later on in the talk, I'll come back to talking about how I worry that regulation, which I think is very necessary for this space, might actually make it worse, because very often what regulation tends to do is to raise entry barriers which essentially means that incumbents get an advantage. But that is a story we'll come back to a bit later. So at the moment, there is a concern. And the other concern is that we are getting many more spillovers between traditional and new financial markets. The notion that we might have an ecosystem that can basically function independently without having access to the traditional financial channels in terms of payment rails or in terms of other banking products and services, that promise hasn't quite been fulfilled yet. So I think we are at a stage in the development of this ecosystem where much of the promise of decentralization and the democratization of finance and the reduction of barriers to entry has not quite been fulfilled. But there is still interesting work going on. And this morning's talk brought us to thinking about a couple of pieces of this architecture that are really crucial. And of course, as we start thinking about developing new financial products and services, it's going to be important to think about how blockchains, which are essentially very independent, self-contained ecosystems, can communicate with the rest of the world. So I want to talk a little bit about some research with my Cornell colleague, Will Song, whose name has been invoked many times already today, and Daniel Rabetti. And what we tried to do is try to see whether the Oracle structure that we are beginning to see out there is working well, and in particular focus on decentralized Oracle networks and what it might be doing in terms of enhancing the value of DeFi protocols. So at this stage, it's a very descriptive paper. We don't have identification yet, but that is coming. But I just wanted to give you a sense of where this stands. Now, to the audience here, of course, I don't need to tell you what oracles are for. They are useful in terms of communicating between blockchains and the real world. And of course, if you want to think about executing smart contracts efficiently, especially in terms of financial contracts, you do need information from the rest of the world. And you may also need to communicate between different blockchains. So oracles are the way you do this, of course. And if you think about a large variety of DeFi protocols, it's going to be difficult for them to function without oracles. Now, the problem, of course, is that relying on single oracles, again, as we heard this morning, creates a variety of vulnerabilities. These oracles could go online, they could be corrupted, they could be mishandled, and this is a pretty serious problem. So the obvious solution as we start thinking about decentralization, of course, is to think about decentralized oracles. Now, I don't think DONs are quite at a stage of maturity yet where they can be fully relied on, but I think some degree of decentralization might be the way to start finding better ways of extracting information from the real world or between blockchains. Now, again, we are still at the relatively early stages of this, but I think we're going to have to think about how to sift through the data that we might get from different oracles. And right now, we are using reputation systems and a variety of other consensus algorithms to try to decide how best to choose among different oracles. But I think much as is the case with various protocols here, the notion of competition, even in the provision of services, might be the right approach to go here. So what I'm going to talk about here is just a very descriptive data about how there is a strong case to be made for DON integration and how it seems to affect the value and usage of different protocols. And I think there is a strong conceptual basis for doing this. Now, at the moment, centralization is again the theme here. We do have decentralized oracles, but it turns out that most of these run through Chainlink, which controls about 2/3 of the market share of protocols that rely on DON. And what is surprising, interestingly, is that when we looked at a large number of DeFi protocols, there is only a small number of them that actually use the services of decentralized oracles. And when we got started on this project, this was an immediate puzzle. Why on earth don't you have greater DON integration? And so we went out and talked to a few DeFi developers, and it's astonishing that there is a huge amount of technical knowledge going into the front end. But in terms of DON integration, it turns out that there are huge lacunae out there. In fact, both of my co-authors received job offers from developers who said, why don't you come work with us and help us integrate our protocols into DON networks? And the other question might be, so if you're not using a DON, what are you using? And here again, the answers turned out to be mind-boggling. Some of them use single oracles that they rely on. Some of them are trying to develop their own oracle mechanisms, and some of them remarkably just scrape data of public blockchains or public sources of information. So there is a very primitive element to the information extraction, but great sophistication in terms of the protocol development itself. So it turns out that if you look at when DON integration took place, for about half the protocols, it took place before these protocols went live, and for others, it was after these went live. And typically, price feeds tend to dominate most of these Oracle services. So these are financially based oracles. So it turns out that you should start looking at a variety of indicators of what seems to generate better total value locked, number of users, and so on. It looks like, in general, DON integration is more related to financially based DeFi protocols, the ones that need information from other financial markets. And we also find that there is a huge positive effect, with one example here being of Avalanche. Once it got integrated with a DON, the amount of liquidity and other measures that you could get on this Avalanche grew enormously after DON integration. So I think this will happen sooner or later. And then if you look at indicators of DeFi protocols performance, market cap or total value locked, you can see that the amount of value added through DON integration, controlling for a bunch of other variables, is pretty significant, and the significance and the magnitudes tend to rise over time as you go from a day after integration to a week to a month to a quarter after integration, and these are the coefficients on the first line. Another interesting question is whether there are symbiotic gains from integration, whether once you have DON integration, you have increased correlation among the protocols on a given chain. And we do find significant evidence of that. Again, taking Avalanche as an example, the amount of correlation between the protocols across a variety of other chains, except that of Binance, tends to increase pretty significantly. And this is just another way of looking at the correlations before and after integration, with the blues showing stronger correlations. So you can see this general pattern of correlations going up. We also find that the more protocols on a given chain that are integrated through DON, there seem to be these symbiotic effects or network effects, which means that the more protocols that are integrated into DON on a given chain, the more correlated they become, up to a point. So these network effects in terms of growth in the user base and so on do again seem to be very strongly integrated, positively correlated with DON integration. So the interesting question is whether one can think about this as being related to other aspects of international finance, for instance, which is the literature I've worked on for much of the time. And it's interesting to think about the parallels between these two. So one can think about blockchains as essentially ecosystems of their own, or like countries. So the more integration you have with other blockchains or with the analog of the global financial system, the question is whether there are benefits. And it turns out that in the international financial literature, there is evidence that cross-border financial linkages increase business cycle correlations, usually increase growth, increase the ability to share risk, and so on. So as we interpret the results that I've just shown you, which again are quite descriptive at this stage, it looks like there is this flavor of international finance that is coming through here as well, that you get stronger correlations, better risk sharing across protocols, and higher correlations. And there also seem to be threshold effects that you need to attain a certain level of DON integration among the protocols in a given chain before you get to see these benefits. So I've spent some time talking about the benefits, but of course one has to take these results and many of the other results that we are seeing in the sort of papers that are presented at this conference with a bit of caution, because after all, this is still a very young market, and it's not clear whether there are going to be other protocols and services that turn out to disrupt the existing protocols. And as you start thinking about more mature and stable markets, it's not entirely obvious that these results will hold up. One of the critical elements, of course, is what regulation is going to do to this space. And that is a nice segue into my next subject, which is thinking about how the regulatory landscape is evolving. And one simple way to characterize it, I think it is going to be somewhat harsh. The reality, as I talk to regulators, is the sense that there is potentially a lot of innovation coming out of this space. But the concerns that there are going to be very substantial spillovers from the new financial system to the traditional financial markets, I think is really growing right now. Let's take the example of stable coins. At some level, stable coins are very safe instruments out there. If you think about Circle, for instance, the amount of collateral that seems to be backing up USD coin is pretty large, and the market seems to believe that this is pretty good collateral, but much of this collateral has to be relatively liquid. As you saw in the last few weeks, it is necessary to have pretty liquid collateral in deep financial markets. Now, the concerns that we are beginning to see are that if you have the sort of redemption runs that you might have on stable coins like we saw on some of the smaller banks in the last few weeks, then you might have spillover effects onto the traditional securities markets that are being used for collateral. Now, if you think about the current market capitalization of stable coins, you add up Tether and USD coin and a couple of other smaller stable coins, it's about $110 or $120 billion. It seems like peanuts relative to the treasury securities market. So the treasury securities market, if you take out the portion of treasury securities held by the Social Security trust funds and also the Federal Reserve on its balance sheet, which is about 6 trillion right now, that leaves about 18 to 19 trillion. And daily volume in these markets is about $500-600 billion by some measures, by some other measures even larger, closer to 1 trillion. So what's 120 billion? But these are very fragile times in US Treasury securities markets. Not only do we have a debt ceiling market problem coming, but we have significant problems in the plumbing of the Treasury securities market that have become quite apparent in the last 2 to 3 years. We had this volatility episode in 2021 and a couple of other smaller, less noticed volatility episodes after that. So I think there is a real concern building up that even relatively safe parts of the cryptocurrency ecosystem like stable coins might end up having implications for the traditional financial system. Now, the way regulators are approaching this is turning out to be quite fragmented. So we have the European Union proceeding with MiCA, the markets and crypto assets framework. The UK has tried to come up with a framework where there is a very precise definition of different categories of crypto assets, tokens, and securities. But of course, one thing we've learned in financial regulation is that once you make the boundaries clear, then there are people who have a very strong incentive to find their way around the boundaries or push the boundaries. So it's not clear that such precise definitions are a great way to come up with clearly defined regulation. In the US, of course, we have the President's Executive Order on Digital Assets, and many agencies are working away very hard at trying to come up with sensible regulation. But going back to an earlier point I made, I worry a little bit that even enlightened regulators might end up putting in place regulations that end up doing one of two things. One is raising the barriers to entry, because once you start putting in regulations, that almost intrinsically favors larger players because there are more reporting requirements, auditing requirements, and so on, that could lead to increasing concentration. And the second issue here again is that once the guideposts are very clear, it somewhat makes it somewhat easier to try to find ways around them. So we might end up with much more concentration of this space with a few market players in different parts of this ecosystem gaining dominance, while some of this activity migrates offshore, some of the more innovative parts. So it's a little unclear. And if one was asked, what is the right way to design regulation? I mean, that is an interesting theoretical and analytical question at this stage. And I don't think we have very clear frameworks. There are some countries like China and India, of course, that have taken a much harsher tone towards cryptocurrencies. And India has the presidency of the G20 this year. And I can tell you that they are trying to push the G20 towards a much more forceful regulatory stance towards cryptos in general. Now, the reality is that in many countries, of course, where payment systems don't function very well, where you don't have well-functioning financial systems, these cryptocurrencies are likely to gain a lot more traction as mediums of exchange, as stores of value, and so on. So I see a sort of balkanization of this entire cryptocurrency space. And of course, cryptocurrencies in principle know no borders, but the reality is that we're going to have much tighter regulation, especially at the point where you have connections between the traditional and new financial ecosystems, which comes to another interesting question about what all this means for money as we know it. Now, I think of money, we hear about the definitions of money as a unit of account, medium of exchange, and so on. So I think of money really in a different way. It's just something that allows us to transfer resources more effectively across space and across time. So if you think about saving and borrowing decisions, that's transferring resources across time. And then, of course, money allows us to conduct trades of various sorts, real or financial, across geographically distant locations. So in terms of functionality, the question is whether we're going to see significant changes in the way money is used. And at some level, I think what cryptocurrencies are showing us is that payments can be much more efficient and effective. If you think about payment systems in many emerging market countries such as China and India, or many advanced economies such as Sweden, you have domestic retail payment systems, digital ones that work very well. In the case of the US, we have pretty antiquated payment systems that are beset by frictions, enormous costs, and so on. And then if you start thinking about international payments, those are order of magnitudes greater in terms of the cost, the efficiency of settlement, in terms of the time to get transactions processed, and the inability to track those transactions in real time. So clearly there are payment inefficiencies, and I think cryptocurrencies at a minimum are showing us that there are technological ways in which you can do a lot better in terms of payments. And that, I think, is actually going to be the true legacy of the cryptocurrency revolution. 10 years from now, I don't know where exactly cryptocurrencies are going to fit into finance, but they have really shown a harsh light on the deficiencies that pervade existing financial systems. And there is no good reason for them to persist, again, except for the fact that there are incentives that lead us towards concentration. So we see cryptocurrencies beginning to play an important role. And of course, CBDCs are beginning to emerge as well. Now, when I wrote my book about, or at least when I handed in the manuscript for my book about 2.5 years ago, I was much more positive about CBDCs. I thought they had very useful roles to play in terms of pulling economic activity out of the shadows, broadening financial inclusion, creating safer payment systems, and so on. Over time, I've become a little less sure. If you think about the lessons that have been learned over the last couple of years, during which many countries have initiated CBDC experiments. So China has undertaken a couple of stages of its pilots. Sweden has undertaken pilots, and now a whole host of other economies, India, Brazil, Japan, have all undertaken experiments. What they're finding is, in fact, that the user case for a CBDC is somewhat weaker than we might have expected. So if you take China, for instance, in China, Alipay and WeChat Pay do a perfectly good job of providing low-cost, easily accessible digital payments. So the question is, why do you need a CBDC? In Sweden, There was a very extensive 2-year pilot that is just concluded, but a parliamentary committee that was set up to evaluate the need for a CBDC basically said just a few years ago, well, it's great that we could have a CBDC, but we don't really need it. But I view CBDCs as inevitable because digital payments are becoming the norm, and I think the notion of physical currency having much greater traction simply doesn't make sense. It's inconvenient for businesses, it's inconvenient for consumers, for the government. It's a huge hassle, providing and distributing cash, which turns out to be quite expensive. So CBDCs are going to come into play. And the question is, do they really belong in a payment ecosystem that the private sector has already set up that is working very efficiently? And the answer is perhaps. You could still have CBDCs that generate certain features like greater interoperability. So Alipay and WeChat Pay are not directly interoperable right now. So you could have a CBDC that essentially generates synergies in the payment system through this feature of interoperability. You could get greater payment system resilience if you have a public option that backstops the private payment system. So there are potentially some benefits, but I think this design is going to have to take some other risks into consideration. There is, of course, the question about privacy, which could perhaps be mitigated using zero-knowledge proofs or other types of identity validation mechanisms. There is also the risk, of course, of CBDC digital wallets, potentially precipitating bank runs. Now, countries that are undertaking CBDC experiments are all moving towards a two-tier approach where essentially the central bank provides the payment infrastructure, then provides the digital tokens which are held in CBDC digital wallets, non-interest-bearing wallets that are provided by front-end financial services providers like commercial banks. So we might arrive at a medium where the payment infrastructure which generates the resiliency of the payment system is managed by the central bank, but at the front end you have these digital tokens that can be used by different payment providers, commercial banks, even telecom companies, in a way that generates much more payment efficiency. But the risk, of course, is that if you have a CBDC digital wallet out there and you get a little worried about the banking system, maybe you don't have more than $250,000 in deposits, but you still worry a little bit that it may take you a while to get your money back from a failed bank, so you might want to move your money to a CBDC digital wallet. This is a risk. This is a risk that central bankers are very aware of. The Bahamas, which introduced the world's first nationwide CBDC, put a cap on the amount that CBDC digital wallets could hold. If you think about what the European Central Bank is contemplating, it's contemplating a limit of about 2,000 to 3,000 euros on its CBDC digital wallet. What the events of the last 2 or 3 weeks have shown us is that those limits might not be sustainable. What we found out, of course, is that when turmoil breaks free and a $250,000 deposit insurance cap does not seem to be viable, suddenly all deposits turn out to be insured, at least for a short period. I suspect that we might end up with a similar situation where if there was a mad clamor to move money to CBDC digital wallets, those caps would be erased, and then you would be left with CBDCs precipitating exactly the sort of financial panic that you're trying to avoid. So I think CBDCs are going to come. They're certainly on their way. The fact that in the US we have FedNow, which is going to lead us to better payments, might delay it, but the reality is that it's coming, and it's going to create a lot of interesting new opportunities, but potentially also a lot of tensions. Now, one question that arises in the context of the conference here is whether there is a role for other cryptocurrencies, especially stable coins, because they might seem to be in direct competition with CBDCs. Both are digital forms of essentially fiat currencies. I think there might be a role to play. If you think about what central banks that are contemplating issuing CBDCs are talking about, they're talking about very plain vanilla sort of CBDCs. Non-interest bearing digital equivalents of cash in monetary aggregates like M0 with no funky features. Now, certainly the attraction of digital money is that it is programmable. You could have funky features in there. You could have potentially expiry dates. You could have negative nominal interest rates that you impose on a CBDC, which might all be wonderful from a policy perspective. But I worry, in fact, that if we move to that world where CBDC's programmability starts being used, that could potentially affect the very integrity of central bank money. Let's take one example of a very effective policy tool where you do helicopter drops of digital money with expiry dates. That's great for stimulating economic activity. But now you might have different units of central bank money that have different characteristics and therefore potentially different values. So you can well imagine a world in which you have units of central bank money with expiry dates that are trading at a discount relative to other units of central bank money. This, I fear, could lead us to a much darker world where the very integrity of central bank money is coming into question. So I think central bankers will be very cautious. I hope they will be about getting there. So I can very well see a role in which you have a CBDC still playing a role as an important payments mechanism, but stable coins still have a role not only as a payment mechanism in the traditional financial markets, but especially in terms of decentralized finance built on decentralized blockchains, where all the functionality built into stable coins and the programmability could give them an advantage. So this comes to a broader theme about money. I think what we're going to see is a very interesting bifurcation of the roles of money. We've tended to have many of the roles as mediums of exchange, as stores of value, essentially being built into the same units of money. I think we could move into a world where the medium of exchange function of money, either issued by the central bank or perhaps by others that use the central bank money as its backing, essentially start competing with official money as mediums of exchange, but the store of value function still remains very strongly with fiat currencies. And there is, if you think about stable coins, they don't have any intrinsic underlying value of their own except as payment mechanisms, but their values derived from fiat currencies. So one can see this separation as likely to take place, and that I think will lead to different aspects of money, and I think that's going to have implications for the international monetary system as well. So I'll connect this theme about the bifurcation of the roles of money in the international context at the end. But I want to make a couple of comments about what this could do to the international monetary system. One area in which we're already beginning to see lots of change, of course, is in the efficiency gains in international payments, which really are not working very well still. But here there is a very strong case for certain types of CBDCs, not the retail ones, which is what I've mostly talked about so far, but wholesale CBDCs, which are used for interbank payment and settlement. Those could be used domestically, but also across national borders. And there are a variety of wholesale CBDC experiments going on across different bank consortia, where we do seem to be seeing much more efficient, low cost, and much quicker payment and settlement of international transactions. So that's going to be useful. It's going to lead to much more efficient payments, which is good for exporters, importers. The horizons over which they need to hedge is going to be much shorter. Economic migrants sending remittances back to their home countries will find it a lot easier. So this is all great. But there is a potential risk. And one risk, of course, comes from the fact that if you think about the conduits for international capital flows becoming much easier and increasing in number, you can very well see that emerging market economies that are already beset by capital flow volatility and the spillovers of monetary policy and other policies from the other advanced economies, those spillovers could become even harsher for the emerging market economies. Now, there is a question about whether a sort of digital arms race might develop in terms of the creation of CBDCs, and there has been this notion that maybe China getting further ahead with its digital yuan or digital renminbi might put the dollar at a disadvantage. Here, I think, again, there is an analogy in terms of these bifurcation of roles of money. I don't think a Chinese digital yuan is going to fundamentally reshape the renminbi's role in international finance. You know, most international payments are already digital, if you think about it. But there is another tool that China has, the cross-border interbank payment system, which is a payment system that can more directly communicate with the payment systems of other countries. Think India, think even perhaps Russia. And that payment system, the CIPS, also has messaging capabilities, which means that SWIFT might no longer be needed as a messaging system. So especially in a world where the US and its allies are imposing sanctions on its geopolitical rivals, you can very easily see international payments migrating away from reliance on vehicle currencies such as the dollar. This was going to happen anyway, because emerging markets are having broader and deeper financial markets. Their payment systems are maturing. So the notion of having to go through the dollar or through the euro as vehicle currencies, that was not a viable proposition in the long term anyway. But certainly, the emergence of crypto-related technologies and the possibilities that they have shown us of how quickly payments can be settled even across borders, that I think is really important, and we're going to have a shift away in terms of the dominance of the existing major reserve currencies in terms of payments. But as reserve currencies, I don't think there is going to be a huge change. For a reserve currency, a store of value, you need deep and liquid financial markets backing the assets in that currency. You need economic size, and you might argue that China has these, but you also need an institutional framework that generates the trust of foreign investors. You need an independent central bank, the rule of law, which even the government is subservient to, and an institutionalized system of checks and balances. Now, each of these pillars of the institutional framework has been tested very sorely in the US for the last few years. So you might say all of this that I'm saying should suggest that the dollar is really on the brink of doom. But the reality is that in international finance, everything is relative. You don't have to be great in any absolute sense. You just need to be greater than everybody else. And if you think about the combination of economic size, financial market strength, and institutional framework, it's hard to see a clear alternative to the dollar. So one might see a slightly declining role of the dollar as a payments currency, but as a reserve currency, I think not. But even here, there is a twist. I spoke about stable coins and about how stable coins are getting traction. The reality is that dollar-backed stable coins are probably what the world is going to want, even if it saw before it an array of stable coins backed up in different currencies. Circle has recently issued a euro-based stable coin, and we'll soon start getting evidence on how much traction it is getting. But my betting is that dollar-backed stable coins will be really what the world wants. And then you might end up with this paradoxical situation that it's not dollars being directly used anymore, but the dollar indirectly becoming even more dominant in international finance as a payment currency, let alone as a reserve currency. So that shakeout is coming. I think we're going to see the dollar remaining important, a significant amount of shakeout among the second-tier currencies, among which actually I would include the euro because it's not done too well. And the space between the dollar and all of these other currencies, the euro, the pound sterling, the Japanese yen, the renminbi, has in fact widened. It turns out that the world does want diversification, but it's really going to the smaller reserve currencies, the Australian dollar, the Canadian dollar, the Swiss krona, and so on. So we're getting those reserve currencies becoming a little more important cumulatively, although each one of them by itself is not very huge. There is one group of countries for which I think this revolution poses an existential crisis, and those are smaller economies, highly open economies, economies that do not have very credible central banks or currencies, because the notion that you could very easily get access to a digital dollar, a digital renminbi, perhaps a stable coin issued not just by Circle, but maybe by one of the large social media or commercial networks, say an Amazon, or maybe one day Meta will revive its stable coin. You could very easily move to a world where those basically displace the domestic currencies and you essentially lose monetary sovereignty. So there is going to be a significant shakeout, I think, coming especially in the second and third tiers. What happens in terms of the dollar's role in the global financial system, I think is going to be the least of the issues. In summary, what I think about as where we are right now is a world where all the promise of decentralized finance has really not been realized still. What we are seeing is many more of the risks in terms of greater concentration, in terms of many of the concerns that regulators are typically concerned about: financial stability, market integrity, investor protection. We've seen real problems arising in each of these areas. So my sense is that promise has not yet been fulfilled, but I still hold to the belief that this technology has, at a minimum, catalyzed a lot of change that is going to lead us to a much better place. But there is also the prospect that we might be moving to a world where essentially all payments become digital and therefore potentially easier to track, easier to surveil. So there is equally a possibility that we might be leading to a much, much darker world. So I'll just conclude with the title of the last chapter of my book, which I think sums it all nicely. A glorious future beckons, perhaps. Thank you. Okay. So I believe we have about 10-ish minutes for questions. Please.
Very eloquently about
Yes. So decentralized cryptocurrencies like Bitcoin, the question is what role they're going to play. Are they going to play the role they were intended to serve, which is as mediums of exchange? And as I mentioned, I don't think they're working terribly well in that dimension. Then the question is, what is the underlying valuation model for something like Bitcoin if it doesn't have any intrinsic use? So certainly from a diversification perspective, there seems to be the notion that decentralized cryptocurrencies like Bitcoin, on account of their scarcity, are going to maintain value. And there is some degree of diversification into those. But in terms of the broader international monetary system, I don't see it as playing a very significant role. One thing that many of these decentralized cryptocurrencies and stable coins might end up doing is making capital flight a lot easier. So they could facilitate capital flying out of a country. And we've seen this actually in China in 2014, 2015, when the renminbi was under serious depreciation pressure and capital was trying to leave the country and the government was trying to block capital from leaving the country. The amount of Bitcoin-related activity from Chinese IP addresses, as best as you could geolocate them, did seem to spike. But will it fundamentally alter the monetary system? I think really it's going to have a catalytic role rather than a front-end role.
potentially someday a bilateral settlement mechanism for countries like Russia and China that are increasingly taking each other's currency exposure and would like to settle that, but they don't want to use dollars or can't.
They can more directly transact between their pairs of currency. So you don't need an intermediary currency, which is the role that the dollar or the euro serve. Because the problem used to be that if you wanted to, convert renminbi into rupees or rupees into renminbi, that was a very thin market and the spreads were very large. But like I said, the financial markets in both countries are developing, hedging instruments are developing, and especially with these new technologies, we get practically instantaneous settlement. That reduces the cost very significantly. So I think it'll be direct pair-to-pair trading.
Thank you for this very stimulating presentation. I have several observations and then questions. The dollar and other currencies have already been digitized, and the main disadvantage is the delay in settlement that is provided by the blockchain innovation and the cryptocurrencies. So I think those advantages can be incorporated into digitized fiat currency system. So you also observe that the international monetary system is being fragmented. It's unfortunately so, and it's not only financially, but it's also politically. Not only the international scheme, the national boundaries are also fragmented. So, wouldn't it be better for the international order, the benefit of all the participants, even though they have different political aspirations, bettering the current system to improve the efficiencies, and still they can have their own currencies in an interoperable environment?
Yeah.
Would this be likely? And also, if I heard you correctly, it seems that the fiat currencies will be here for the foreseeable future. Is that so?
So that's a very stimulating set of questions too. My sense is that the trust that seems to be embedded in fiat currencies is not going to be easy to displace. I made this observation about how things even in the crypto sphere are becoming more centralized. So the question is, why is it that people are flocking to centralized exchanges for custodying and trading of their assets? At one level, it's because it makes things a little easier, but the notion that somebody is holding my money rather than the money is out there in the ether in some inchoate form, that seems to be compelling to people. So at the moment, I don't see a clear departure from a fiat currency dominated system. What I do see again is this use of fiat currencies in much more efficient ways. But to your point about whether we need more efficient international payments and whether that might affect the international monetary order, we are certainly going to move towards more efficient international payments. As I mentioned, at a minimum, the official channels through these multiple CBDC experiments or CBDC bridges, those are showing that there is a great potential. You still need traditional intermediaries on the two sides. So yes, you can have central banks that set up these wholesale CBDC bridges, but then they connect to traditional financial intermediaries. So one question might be whether these bridges can be connected to non-traditional financial intermediaries, or we can have cryptocurrency technologies basically reducing the need for these bridges, because Ripple has already shown us through proof of concept that you can get instantaneous settlement. The difficulty is that there are many more complications in international payments, exchange rate risk, counterparty risk, which is there in most transactions, but the exchange rate risk is an important issue. But if you can get instantaneous settlement, that basically doesn't quite eliminate, but almost entirely mitigates that risk. So we are getting to that world, but my worry here is that it becomes much more difficult in that world for certain currencies to persevere, because we can all say we need monetary sovereignty, and you're right that a lot of currencies are already digital when it comes to international payments. But if you have easily available versions of official or non-official digital currencies being available, I see the landscape being very harsh for certain currencies which are just too small or not credible for them to continue. Even in a less digitized world, we had dollarization in many economies, particularly in Latin America. So you basically have that phenomenon of digital currencies basically overrunning your domestic payment systems in practically every country.
So on that, you mentioned that there has to be a reserve currency. So if you're saying there would be instantaneous settlement, then why would you need a reserve currency like dollar in terms of CBDC? Why couldn't like each country just transact in their own CBDCs in international settlement?
Okay. We don't have much time, so let me take 2 or 3 more questions and I'll do a summary response for all of them. Is there anything else? Yes, please.
So I just want to take one step back on your definition of blockchain and the use case for it. If you take away Bitcoin, you go to second generation blockchains like Ethereum, they have much broader use case. And this is really a general purpose technology, which has the purpose of serving as a common resource that the financial sector or other people can use. And one of the things I think which is really critical there is it gives power to an individual. Because if you think of the role of our financial system as it is it serves two purposes. It provides services, banking services, and so on, but it also gives access to the financial system. And that kind of is what a blockchain takes away, the access role if you want the access control, which is, I think, for regulators a little scary because all of a sudden individuals have much more power and choice. And it's much harder to regulate because you obviously would have to think about what the individual is doing, whereas nowadays you can actually have a lot of roles imposed on financial institutions. So in many ways, and if you think about it in that way, that individuals are given power, I think you have to think in terms of what the policies that you have and regulations that you impose on the space and what people are doing in a different light, because you're going into after whether or not people should have and I don't want to be one of those guys, but the question is if you should give people the freedom to actually do this, or if you feel comfortable that a unelected official can take away those choices from you. And I think I'd like to speak to that maybe a little bit, if you can.
Yes, please.
There's no privacy concerns with like a central banking digital currency, right? Like right now, my data is not sitting somewhere in a centrally hosted location, and for like national states and actors, like let's say Raytheon, Boeing, Lockheed Martin, now all have all their financial transaction data at the CBDCs. What are the sensitivities around having all that data in one place? And it just becomes a very attractive target.
Okay. All right, maybe one last question.
Yeah, just try to be quick because you kind of hinted towards the idea of coexistence of CBDCs that don't have fancy features and stable coins. And I think we're making a lot of parallels to international finance. Like, isn't it resembling a little bit a choice between a country joining a currency union rather than having a currency board, which I thought is somewhat less efficient for the reasons that you said, because you need to hold these big reserves. So if US dollar-based digital things are useful in the ecosystem, why not CBDC with a wider purpose rather than to do?
Okay, all right. So first on the issue about blockchains and what they enable, I think you're right. The notion of democratization of finance was an appealing one. And I think from a regulator's point of view, if the rules of the game were clear enough so that you did not have unsophisticated retail investors, you're taking on risks that they don't understand, or if there are products that look like traditional financial products such as securities are being marketed as such, but without the regulatory oversight, and most importantly, if these spill over into the traditional financial system, I think it raises a set of concerns that regulators, I think, find it difficult to avoid. So the blockchain technology, I mean, even China seems to believe that blockchain technology can play a useful role, although without the individuals necessary having a great deal of power. So you get the blockchain being used, but in a much more centralized way, which I think is what we are beginning to see across this entire ecosystem. So from a regulator's point of view, I think the traditional pillars of financial stability, especially spillovers in a systemic way, the market integrity, especially if you have things like stable coins affecting payment rails and also underlying securities markets, and then investor protection. These are all issues that regulators cannot ignore. So if the system proved to be durable enough that the decentralization basically meant that you had lower risk, then I think there would be much less concern. But in all three pillars, I think we are seeing spillovers. So regulation is coming. And at one level, it may be good for this space, but at another level, as I argued, we may end up with a much more perverse outcome where all of these benefits of decentralization are lost. So the question that you posed is an important one. I don't think we quite know where to strike the right balance, but it's clear that regulating this stuff out of existence is not a good answer, but also not having any regulation is not a good answer. So designing effective regulation that allows this innovation to take place, and we can talk about this as a mantra, but in practice it's pretty damn hard. On CBDCs, the notion of a reserve currency is again something that you hold as a store of value for difficult times. It's a rainy day funds for central banks. If you think about private investors, they want a safe place to put their money. at times of turmoil. So even if you had very efficient payments, that demand for reserve currencies, I think, is not the key part of the demand. If you think about FX reserves, those are about 12 trillion, of which about 7.5 are held by emerging markets, and those are being held really as rainy day funds. So even if you had very efficient payment systems that reduce the need for hedging, I don't think it'll fundamentally alter the need for reserve currencies, because you're using those to deal with capital flow volatility, exchange rate volatility, and so forth. On the privacy issue, it's a tough one. I mean, what China is doing with its digital renminbi experiment, for instance, is they're offering 5 grades of digital wallets. The lowest grade is going to be something that can hold only low balances, can be used for low value transactions. You can in principle get that with your mobile phone number. The high value transactions, high balances, have to be maintained by commercial banks, and they have to meet your know your customer conditions. Now, the issue is that no central bank wants to allow its money, digital or otherwise, to be used without auditability and traceability. So whether we can put in place some mechanisms, again, using zero knowledge proofs or something of the sort, to provide identity verification but still transactional privacy, I'm hoping that we can get there. And I think design choices, both technical and conceptual, can mitigate many of the risks I spoke about: privacy, disintermediation of banks, squelching private sector payment information innovation, but I don't think they can eliminate them entirely. So we're going to have a discussion about these issues, not just as economists or technocrats, but as a society, how much we're willing to give up for this. But a different way of looking at this, the Googles and Apples of the world know everything about you already. So is it much worse if a government knows about it? Perhaps. And again, that's a discussion we need to have. On the, and this is my final set of comments, on the international front, I do worry a little bit about the monetary system we are moving towards, and whether this is going to be one that is more stable through more decentralization. And again, there's an analog at the domestic level and also the international level. At one level, you might say that less concentration is better. But if you think about the global financial system right now, I mean, if we were starting with tabula rasa, you would not end up with the sort of dollar-dominated system we have right now. But given where we are right now, with financial markets being very fragile, perhaps it's not bad to have one dominant currency, because when panic breaks loose, what everybody wants is one trusted currency, which is the dollar, and the ability of the Fed to provide it in essentially unlimited quantities prevents things from becoming even worse. So this is by no means an optimal equilibrium, but it is a sort of inefficient yet self-reinforcing equilibrium that we are stuck in right now. So I think, given where we are trying to move to multipolarity, we actually have some disadvantages rather than what we have right now. But this is not a statement about things being good. It's a statement about things being in such a dire situation that actually, if you try to shake things up very drastically, you might end up with potentially a worse outcome. Not bad, not good to end on a down note, but I hope we'll hear papers this afternoon and tomorrow that will lead us to, again, this much brighter future. So thank you.